This is the story of why several legendary investors are positioning for a major market crash in 2026, while every Wall Street bank is telling you to buy. Right now, the United States stock market stands at the second highest valuation level in history, with multiple warning indicators flashing red in ways we haven't seen since the dot-com bubble. And beneath the surface, there are financial fault lines that most investors don't even know exist. What makes this situation unusual isn't conspiracy theories or hidden bank documents, because the data is completely public and the warnings are on the record. What's fascinating is the stark disagreement between some of the most successful investors in history and the entire institutional Wall Street consensus, which means one side has to be dramatically wrong. Today, we're walking through 5 major areas of concern, starting with the historical patterns that repeat before crashes, then moving to current valuation metrics that approach or exceed previous peaks, the debt levels piling up across every sector of the economy, what notable investors are actually saying on the record, and the specific vulnerabilities in the banking system that could amplify any downturn. After that, we'll look at what could actually trigger problems in 2026. By the end, you'll have the factual foundation to make your own assessment about whether we're headed for another major crash or if this time really is different. Here's what we know for certain. The United States has experienced 5 major market crashes over the past century, and when you examine them closely, consistent warning signs appear before almost everyone. The 1929 crash remains the standard for catastrophic market decline, with the Dow Jones falling 89% from its peak of 381 down to a trough of just 41 over 34 months, requiring 25 years for the market to recover to its nominal high. Before the crash hit, the price-to-earnings ratio had reached 32.6, which was double the historical average, while margin debt exceeded the total amount of currency circulating in the United States. 1/3 of all banks failed and unemployment reached 24.9%. Black Monday in 1987 comes next, producing the largest single-day percentage drop in history at 22.6% or 508 points. But here's what's interesting. No recession followed and recovery took only 2 years. The PE ratio stood at just 21 to 23 times earnings, making this a liquidity event rather than a valuation bubble, and no yield curve inversion preceded this crash, which is a detail worth remembering because we'll come back to it. The 2000 dot-com bust crashed the Nasdaq 78% over 31 months, with recovery taking 15 years until April 2015. December 1999 saw the Shiller CAPE ratio reach its all-time high of 44.19. Only 14% of tech IPOs were actually profitable, and 39% of all venture capital flooded into internet companies. The yield curve inverted approximately 12 months before the recession began. October 2007 marked the peak before the 2008 financial crisis, which dropped the S&P 500 by 56.8% down to a March 2009 low of 676, making it the largest decline since World War II and wiping out $14 trillion in household wealth. The yield curve had inverted back in January 2006, a full 22 months before the recession officially started, while mortgage debt reached 73% of GDP and household debt-to-income ratios climbed to 138%. Then 2020 and COVID brought the fastest bear market entry ever, with stocks falling 34% in just 33 days, though recovery came in only 5 to 8 months thanks to unprecedented Federal Reserve and fiscal stimulus. August 2019 brought the yield curve inversion just 6 months before the crash. So the pattern shows us that yield curve inversions have preceded every recession since 1955 except one in 1966. 3 of the 4 worst bear markets started with Shiller CAPE ratios exceeding 27, and margin debt growth exceeding market growth by 2 times or more preceded the crashes of 1929, 2000, and 2008. Now let's see how many of these warning signs exist today. December 1st, 2025 puts the Shiller CAPE ratio between 38.9 and 39.9, according to Guru Focus and Robert Shiller's own data, which is 75% above the long-term trend line of approximately 16 and exceeds the 2007 pre-crisis level of around 27. Only one time in American history has the CAPE been higher, and that was during the dot-com bubble when it peaked at 44.2. Markets currently sit at 2.3 standard deviations above the historical average, which multiple valuation models rate as strongly overvalued. Warren Buffett has described the Buffett Indicator as probably the best single measure of where valuations stand at any given moment. And in a 2001 Fortune interview, he said ratios above 120% indicate overvaluation. September 30th, 2025 saw the Buffett Indicator reach between 221 and 230%, with total United States market capitalization at $70.68 trillion against $30.77 trillion in GDP. This represents the highest reading in history, substantially above the 2000 peak of around 160% and the 2007 peak of approximately 100 to 110%. Trailing price-to-earnings ratios range from 29.46 to 31.28 as of December 2025, roughly 90% above the modern-era average of approximately 16 to 17. Timing becomes critical when you look at the yield curve, which inverted in July 2022 for the 2-year versus 10-year spread and remained inverted for approximately 26 months, the longest inversion in 45 plus years. December 2024 brought normalization, and as of October 2025, the 2-year to 10-year spread stands at positive 53 basis points, which is normal. But recessions historically follow inversions by 12 to 18 months, which means if you do the math, the risk window extends from late 2025 through mid-2026, and we're in it right now. November 2025 saw margin debt reach a record $1.21 trillion according to FINRA data, up 36.31% year over year. As a percentage of GDP, margin debt now stands at approximately 3.48%. higher than both the 2000 peak of around 2.6% of GDP and the 2007 peak of around 2.5% of GDP. What we have is this: the second highest CAPE ratio in history, the highest Buffett indicator in history, the highest margin debt as a percentage of GDP in history, and we're inside the historical window where recessions typically arrive after yield curve inversions. But valuations alone don't cause crashes, because crashes happen when something breaks under the weight of those valuations, which brings us to what could break. Federal government debt tells the first part of the story, with United States national debt reaching between $36.4 and $38 trillion by October 2025, and debt to GDP standing at 120 to 124%. Annual interest payments hit $879.9 billion in fiscal year 2024 alone, while the Congressional Budget Office projects debt to GDP will exceed 100% in 2026 and reach 118% by 2035. Corporate debt presents structural concerns that didn't exist in previous cycles, with over 90% of leveraged loans now covenant-lite according to S&P Global's 2024 data, compared to just 10% before the 2008 crisis. Covenant-lite loans are corporate loans without the traditional financial guardrails that protect lenders, because standard loan covenants require borrowers to maintain certain financial ratios like debt to EBITDA limits, minimum cash flow coverage, and maximum capital expenditure restrictions. These covenants give lenders early warning signs and the ability to intervene before a company collapses completely, but covenant-lite loans eliminate most or all of those protections. Companies can pile on more debt, burn through cash, and deteriorate financially without triggering any alarm bells until they actually default, which helps explain why the leveraged loan default rate reached a decade high of 5.6% by late 2024, according to FTI Consulting. Total household debt reached between $1820 and $1839 trillion as of the first and second quarters of 2025, according to the New York Fed, with credit card balances hitting between $1.17 and $1.23 trillion. Serious delinquency rates, meaning 90-plus days past due, climbed to 11.1% as of the third quarter of 2024. During the 2008 subprime crisis, credit card delinquencies peaked at 13.7%, and we're approaching those levels right now. Auto loan transitions to delinquency reached 7.9% annualized in the third quarter of 2024. While student loan serious delinquencies surged to between 9.4% and 10.2% after pandemic forbearance ended, McKinsey's fourth quarter 2025 consumer research found that 75% of consumers reported trading down in at least one category, 29% dipped into savings in the prior 3 months, and the personal savings rate fell to just 4.5 to 4.6%, well below pre-pandemic norms of 7 to 8%. Sales of Hamburger Helper surged 14.5% through August 2025, while rice purchases rose 7.5%, which economic researchers identify as classic recession preparedness behaviors because consumers stock up on cheap, shelf-stable foods when they're worried about the future. Record debt at the government level, unprecedented lack of protections in corporate lending, and consumers showing signs of stress despite relatively strong headline numbers gives us 3 potential pressure points. The financial system can absorb a lot of stress if banks are well capitalized, so let's look at the banking sector specifically. Before we get to the banking data, look at this remarkable disagreement between some of the most successful investors in history and the entire Wall Street institutional consensus. Every major Wall Street strategist projects stock gains through 2026, with JP Morgan, Goldman Sachs, and Morgan Stanley all targeting the S&P 500 at 7,500 for 2026, approximately 10% above current levels. Bank of America targets 6,166 for the end of 2025, and the National Association of Business Economists surveyed 71 economists, where only 6% believe a recession will occur in 2025. With 71% saying none until 2026 at the earliest. Now here's what's happening on the other side. Ray Dalio, founder of Bridgewater Associates, the largest hedge fund in the world, has been the most specific with his December 2025 statement saying 3 years give or take, a year or two for a debt-induced crisis. That points to a 2026 to 2030 window, with 2027 to 2029 most concerning, and at the March 2025 Converge Live conference he warned the United States must sell a quantity of debt that the world is not going to want to buy. His words were that the situation is imminent and of paramount importance, and he's advocating diversifying internationally, owning real assets like gold, and reducing exposure to traditional dollar-denominated debt. Jeremy Grantham at GMO described the current market in February 2025 as a super bubble with these exact words: "A major decline is imminent, and the longer and the higher they climb, the worse it is." Current United States valuations have surpassed 1929 and 2021 according to his analysis, falling second only to Japan's 1989 bubble, and his assessment is that the market could easily go down by 50% and be well within its historical boundary. Michael Burry, the investor who predicted and profited from the 2008 housing crash, established a $1.1 billion bearish bet against AI stocks in November 2025, with put options on Nvidia coming to roughly $186.6 million and puts on Palantir totaling approximately $9 and $12.1 million, which is about 80% of his portfolio. December 2025 saw him highlight a Wells Fargo chart showing that stocks now comprise a greater portion of United States household wealth than real estate, and he pointed out this condition has occurred only twice before, in the 1960s and pre-dot-com 2000. Warren Buffett hasn't issued dramatic predictions, but his actions speak loudly because Berkshire Hathaway's cash pile reached a record $381.6 billion as of the third quarter of 2025. The company has been a net seller of stocks for 12 consecutive quarters. Buffett sold $134 billion in stocks during 2024 alone. He significantly reduced his Apple stake over 4 consecutive quarters, and Berkshire hasn't conducted stock buybacks for 5 consecutive quarters. His 2024 annual letter noted that often nothing looks compelling. Unanimous Wall Street bullishness sits on one side, while the other side has Ray Dalio warning of an imminent debt crisis, Jeremy Grantham calling this a super bubble with 50% downside, Michael Burry betting over $1 billion against AI stocks, and Warren Buffett sitting on a record cash pile after selling stocks for 12 straight quarters. One of these groups is going to be spectacularly wrong. Banks are sitting on $395.3 billion in unrealized losses on securities as of the second quarter of 2025, according to FDIC quarterly banking profile data, down from $482.4 billion in the fourth quarter of 2024, but still considered elevated. Peak crisis levels during the third quarter of 2023 reached $684 billion in these losses. When banks buy bonds or other securities, they're recorded on the balance sheet at purchase price, but when interest rates rise, the market value of those bonds falls. As long as the bank holds them to maturity, they don't have to recognize the loss. But if they need to sell them because depositors are withdrawing money and the bank needs cash, those unrealized losses become very real losses. The Office of Financial Research noted in May 2025 that these unrealized losses equal 8.6% of the fair value of securities holdings and 19.9% of aggregate bank equity, specifically warning about vulnerability if other developments, such as a large surge in commercial real estate loan losses, make depositors question a bank's viability. And that brings us to commercial real estate. Banks hold approximately $3 trillion of the $5.9 trillion in outstanding commercial real estate loans according to Federal Reserve data, and we're hitting what's called the maturity wall. Approximately $957 billion to $1 trillion in commercial real estate loans must be refinanced in 2025, with another $936 billion to $1.8 trillion coming due in 2026. Many of these loans were originated when interest rates sat around 4.5%. And now borrowers are refinancing at around 6.5%, which for a building that's already struggling with vacancy or declining rents can be the difference between viability and default. National office vacancy reached 20.1% according to Moody's, a 30-year record high, with San Francisco leading at 28.8% vacant, followed by Austin and Seattle at 27%. CMBS office delinquency rates hit 9.4% in October 2024, the highest since the worst months following the 2008 financial crisis, and double the June 2023 level of 4.5%. Large banks are actually in pretty good shape, with all 31 major banks passing the 2024 Federal Reserve stress tests, and aggregate common equity Tier 1 capital ratios declining only 2.8 percentage points to 9.9% under severely adverse scenarios. All remained above minimum capital requirements, and major bank CET1 ratios currently stand at 10 to 13%, well above minimums. Regional banks show the vulnerability because according to FDIC data, 67 banks have commercial real estate exposure exceeding 300% of their equity capital. Flagstar Bank leads at 553% CRE to equity, while Zion Bank Corporation sits at 440%. These banks face the same dynamic that collapsed Silicon Valley Bank, Signature Bank, and First Republic in 2023, meaning high commercial real estate exposure, unrealized losses on securities, and vulnerability to deposit flight. Office buildings or retail properties in their lending portfolios that start defaulting make depositors nervous, and when depositors withdraw money, banks have to sell securities at a loss, which confirms depositor fears and accelerates withdrawals in a classic bank-run dynamic. The system as a whole has enough capital to weather a normal downturn. But if multiple stresses hit simultaneously with commercial real estate losses, a broader recession, and a stock market crash that makes depositors nervous, that's when regional bank vulnerabilities could amplify the problem. We've established the warning signs exist and the vulnerabilities are real, but markets can stay overvalued for extended periods because the dot-com bubble inflated for years before popping, and the housing bubble was obvious to many observers in 2005 and 2006. Yet the crash didn't arrive until late 2007 and 2008. What could actually trigger problems in 2026? Core inflation persists nearly 1 percentage point above the 2% target as of late 2025, putting the Federal Reserve in a difficult position. Atlanta Fed President Raphael Bostic warned in December 2025 that a half-decade, and likely soon to be longer, of missing the inflation target could well imperil the committee's credibility. Tariff impacts are expected to push inflation higher into 2026, potentially forcing difficult choices between fighting inflation by keeping rates higher, which risks recession, or supporting economic growth by cutting rates, which risks losing credibility on inflation. A policy error in either direction could trigger market stress. Unemployment rose to 4.6% in November 2025, up from 4.2% a year prior, while employment growth slowed dramatically to approximately 17,000 net new jobs per month in August through November 2025, compared to 139,000 monthly in the prior 6 months. Job openings fell to between 7.18 and 7.7 million, down from highs above 11 million in 2022. The SARM rule has triggered during all 11 recessions since 1950 by measuring the 3-month average unemployment rate against the lowest 3-month average from the previous 12 months. And if unemployment rises by 0.5 percentage points or more, the SARM rule triggers. Analysts say it's inching steadily closer to activation, though it hasn't triggered yet. China conducted its largest ever war games around Taiwan on December 29, 2025. Trade tensions remain unresolved, and CEOs rank intensified trade wars as their top conflict-related geopolitical business risk according to surveys. Beyond the debt statistics and the hamburger helper purchases, you have 75% of consumers trading down in at least one category, 29% dipping into savings, and the personal savings rate at just 4.5 to 4.6%. Consumer spending represents about 70% of GDP, so if consumers pull back sharply, that flows through to corporate earnings, which could trigger the stock market correction that makes those bank vulnerabilities relevant. Here's what we know for certain. The United States stock market is more expensive than at any point in history except the dot-com bubble peak. Margin debt sits at record levels. Debt across government, corporate, and consumer sectors is at or near historic highs, and we're inside the historical window where recessions typically arrive after yield curve inversions. Banks carry significant unrealized losses and face a massive commercial real estate refinancing wave in 2025 and 2026, while several legendary investors with multi-decade track records are positioning for a major decline. At the same time, we know that every major Wall Street strategist predicts gains through 2026. Large banks maintain strong capital positions, corporate earnings growth remains solid, and unemployment, while rising, sits at just 4.6%. The yield curve inversion, which has preceded every recession since 1955 except one, has now gone 26 months without yet producing a recession, making it the longest inversion in 45 years. So will 2026 bring the crash that Ray Dalio, Jeremy Grantham, and Michael Burry are positioning for? Or will this be the second false positive from a yield curve inversion in 70 years, proving Wall Street's bulls correct? Markets are complex systems influenced by policy decisions, geopolitical events, technological changes, and human psychology, which means nobody knows the answer. The warning signs are real and the vulnerabilities are documented, but crashes require catalysts, and timing is always uncertain. What you can do is understand the factual landscape, meaning where valuations stand relative to history, what debt levels exist across the economy, where the banking system has vulnerabilities, and what could potentially trigger a cascade. Then you can make your own informed decisions about your personal risk tolerance and positioning. History tells us for certain that every single person who claimed this time is different at previous valuation peaks was wrong, but it's also true that markets can stay irrational longer than you can stay solvent betting against them. The data is on the table, the warnings have been issued, and 2026 will tell us who was right.